Good afternoon, everyone. My name is Mitchell Sneddon and I'm the Head of Portfolio Services here at InvestSMART. And this afternoon, what we're going to be doing is we're going to be taking a look at some international markets and why you're underexposed in those international markets and how you can gain more exposure to those international markets. But before we do get started, just a little bit of housekeeping. This is a live Q&A, so we are live and you are able to ask questions as we're going. So just below the little screen there with myself in it, you'll see the questions box. Simply put your name down there, fill out a question, hit submit, and I'll do my absolute best to get through it once I've gotten through the formal part of today's presentation. And also, if I cannot get through to your question in time, please submit your email address to me or email me directly. My email address is m.sneddon, that's SNEDDON, at investsmart.com.au, and I'll get to your question once we're finished up here. But in the meantime, let's get to my first and most important slide of the day. That slide is our disclaimer. So we're going to be talking about stocks, we're going to be talking about exchange-traded funds, and we're going to be talking about investing in general. And because we don't know your personal circumstances, this is to be taken as general advice only. So now that we've got that out of the way, we can get started with the presentation. Now, the reason why I think this is a really important presentation, an important one for people to tune into, is not just because we've seen international markets go on such a fantastic run over the last a couple of years, but also because if you're running a diversified portfolio, you're pretty much not just at risk of missing out on those returns, but you're also well and truly at risk being overexposed to one or two different asset classes. We crunched a few numbers here at InvestSMART, and we on the back of people's portfolio manager data as a whole, so we aggregated it together, and we found that people as a whole were 80% underweight international equities. So that means you're certainly going to be overweight somewhere else. And that means you're going to be leaving yourself overexposed somewhere else. And so therefore your portfolio is potentially taking on more risk in a certain area than what it should be. So this is why we've decided to do this particular presentation. And I think it's quite a timely one as well, given what is going on in global equity markets right now. So let's get into our first slide here about why you don't have international exposure in the first place in your portfolio. Maybe you don't have the knowledge to go out and buy direct equities. You might be comfortable buying Woolworths and BHP and CBA, and you use Telstra, and so you're comfortable and familiar with those. You've watched these companies, a lot of them since they IPO'd, and you're very familiar with them and can understand them, and so therefore you invest in them, and that's exactly what you should do. But you might not also want to go out there then and pay a fund manager fees to invest for you, because by and large, a lot of active fund managers will underperform the index that they're trying to beat over the long term. And then, of course, you don't know what regions to buy. For example, Asia recently has done approximately about 30% over the last 12 months. Is it time to be buying Asia, or have you missed the boat, etc.? And so you might be handcuffed there by your own decisions and your own indecision about what areas and regions to target. And then, of course, you've got currency concerns. The Australian dollar right now, last I saw it was about 79 cents, sitting a little bit unusually high. Does that mean it's a good time to be investing? What if it does continue to strengthen against the US dollar? What if it continues to rise? What if it pulls back? What does it mean for your investing? And because of those uncertainties there, that might also stop you from investing internationally. But I think there's one other aspect to take into consideration as well, and that's on this next slide. It could be because of this guy, Paul Keating, and the introduction of franking credits, imputation credits, in the 1980s. I was sitting in our office here in Melbourne the other day, and I was talking to an investor and discussing his portfolio with him and taking a look. He knew exactly that he was underweight international equities, and he asked what the yield on our international equities portfolio was. And when I said it was approximately 2% or maybe even a little bit less, he physically cringed. And that's because he's become so reliant, as have most Australian people in pension mode and their self-managed super funds, so reliant on dividends, and then of course receiving that franking credit back. And so that, of course, considering our market is made up so much of with superannuation money, and because it's kind of dictated to how a lot of the big corporations out there manage their capital allocation. And so you'll see a lot of them preferring to pay out large dividends to keep the investors happy, rather than retain it to look to grow the businesses. So that's what I've pinpointed or highlighted here on the next slide of dividends and franking credits. Investors are leaning on these to their own detriment. And I've got a slide coming up, and when I say their own detriment, you're leaving returns on the table by focusing too solely on dividends. I've got a slide coming up showing comparing the ASX 200 to, say, the S&P 500. And it's chalk and cheese when you're looking at performance-wise. Even if you do add in the dividends that we've been paid as investors, you still don't come close to the price return that the S&P 500, for example, has returned in Australian dollars to investors. Australia is the highest yielding developed market in the world. There's 23 developed markets around the world, and Australia is literally the highest yielding market out of all of those. And the imputation credits are a very large reason for that. Now, we can go to undeveloped markets, and you'll see the likes of Romania, I believe, has a higher dividend yield, but maybe slightly out of our area of expertise investing in Romania. And so a lot of people get caught up on the yield and miss out on that larger total return aspect. One thing that a lot of investors should remember is you can eat capital growth as well as you can eat yield. So that just means being disciplined and trimming a little bit of your holding there and taking your profit and using that cash as well to get your total return. And the reason why I say has yield handcuffed Australian growth, talking about the capital allocation decisions of a lot of our CEOs out there, it's very easy to keep their shareholders happy and pay out a large dividend, and then you don't actually have to have those decisions about how you reinvest that capital into your business to look to grow the business going forward. So another reason to look at international equities, I mean, I'm sure you've all heard with many fund managers out there promoting and spruiking new international funds that the Australian market only represents 2% of the global market. Well, that is true, but what I want to focus on is something a little bit different as well. If you look at our market as a whole, you can basically sum it up on one hand. We've got a couple of banks, we've got a supermarket or two supermarkets, we've got a telco, and we've got a couple of resource companies. So I've just basically said about 80% of the Australian market right there in just a handful of stocks. So really, even if you are investing in, say, an ASX 200 ETF and you think you're naturally diversified, you're holding 30+%, almost 40% in financials. That doesn't sound overly diversified to me, and 4 companies make up the bulk of that weighting. Now, let's jump forward here into the next slide, and we've got us versus the US. Now, what I want you to pay attention to is the information technology space here. IT makes up of 23% of the S&P 500. If you've got a photographic memory and think about the slide previously, you would see that IT approximately was about 1.8% of the ASX 200. So by not diversifying into these bigger global markets, you're actually missing out on some of those names, like the names that we all know: Google, Amazon, Facebook, etc. And of course, that small little company called Apple. Another thing to think about here as well, if you do have that photographic memory in action, the ASX 200 was about 7% healthcare. And there's a strong thematic IT and then also global healthcare that a lot of investors want to play in as a long-term growth trend. Not just Australia just doesn't have an aging population, a lot of the world does, and healthcare is going to be one of those ongoing long trends for people who will be looking to invest in. The S&P 500 is more than double Australia's allocation to healthcare. So by investing in the S&P 500, you're doubling your exposure there to healthcare. Australia was about 7% on that previous slide. So you're not just, of course, moving away from investing in Australia as a region, but you're also diversifying around the world. Now, if I was to put up the 50 largest companies in Asia, I believe about 40% of the market cap weight is made up of IT stocks. That's 40% of Asia. So you then, by once again diversifying globally, you're adding much more exposure to these high growth asset classes. So let's continue to move forward. Now, this next chart once again shows the stark comparison. I just want to put a disclaimer here. I got this chart just straight off ComSec. No fancy work done on my behalf. And the yellow line there is the ASX 200. When I took it's above that a little bit more now. And the blue chart, of course, is the S&P 500, both in Australian dollar returns. And you can see it's chalk and cheese. Even if you added back in the dividends here, you'd still be a long way down from the US market. Now, as an investor, even as an investor living off my fund, what would I prefer? I'd prefer to be taking some profit and getting 60+% return than just getting my dividends and living off those from the Australian returns. So now, how do we all know why we're underweight international equities. And if you were sitting at home and asked yourself that question, you would have been able to answer it even before I mentioned a thing. You know that you are wedded to your imputation credits and your dividends. But you are leaving so much on the table. But also, you might not have the expertise. Now, getting an international broking account, it's expensive. You have to fill out W8 Ben forms, etc. if you're looking to invest in the US. But one thing, what we do, we like to specialize and invest directly where we believe we're experts. So, for example, we have the Intelligent Investor Analyst team who invest in our Australian equity portfolios. So they go out there and they handpick about 20 to 30 stocks to look to outperform the market, because we believe we have an edge when it comes to analysing Australian equities. That's in our Intelligent Investor Equity Income portfolio and our Intelligent Investor Equity Growth portfolio, and in the InvestSMART Small Companies Fund. And the results there speak for themselves. So we believe we've got an edge, and so far the results are showing that. Now, where we don't believe we have an edge, we do not have an international equities team in InvestSMART. And so, therefore, we still know we need to get that exposure for our clients and for ourselves and for our coverage, and for getting a diversified portfolio, of course. But how do we go about getting that when we are not the experts in that area? Well, when you're not the experts in the area, you can't go out and buy individual stocks. You buy a basket of stocks. So what we've decided to do is nothing too smart and nothing too clever. It's to buy a broad, diversified basket of exchange-traded funds and get our exposure that way. That way, what we're doing is eliminating the single risk of handpicking individual companies. So exchange-traded funds, how do they actually work? Well, they're index tracking. So they can track an index that already exists, like, for example, the S&P 500, or it can track an index of the issuer's creation, and that's, say, some smart beta exchange-traded funds where they base their funds off a certain few set of rules, and they create the index, and then the fund tracks that index and mirrors the stocks, and therefore mirrors the returns of that index. So, of course, they're similar to a standard managed fund. Basically, cash goes in and cash can come out, but you do that on the market. So you literally just type in the code in your ComSec account, or your NAB trade account, etc., and you can buy online nice and easy. Now, of course, they can use multiple different investment strategies, but we like to stick with the, generally speaking, stick with the passive standard index tracking ones. And of course, how it actually works behind the scenes, there's market makers buying and selling units to create liquidity. So basically, when you're buying into the ETF, they're creating units and selling them to you. When you're selling out of the ETF, they're buying back those units to create that liquidity. So you don't, generally speaking, never have a liquidity issue with an exchange-traded fund, as you might have, say, a liquidity issue with trying to buy into an international listed investment company, for example. So the pros and cons of using ETFs: you get instant diversification, they're low cost. For example, we're going to take a look at the iShares S&P 500 ETF. Believe it or not, the management expense ratio, and that's what you need to look at with ETFs, the management expense ratio. The iShares S&P 500 one has a management expense ratio of 0.04% per annum. So 0.04% per annum. You might be familiar with most managed funds out there that charge 1%. Think about that in that context. They're charging you 0.04% to gain exposure to the S&P 500. A pretty small price to pay for what we did see were pretty large returns. And they invest in very specific themes. I know we've got some questions coming up, and I think I saw one before looking at Japanese healthcare. I don't know if we can find any Australian listed ETFs that specifically focus on that, but if you want to look to invest in global healthcare, I know there is one. The ticker code is DRUG. If you want to invest in global cybersecurity, if you think that the global cybersecurity industry will be a thematic that you want to invest in for the long term, then you can go out there and invest in one. The ticker code is HACK. And then global agriculture, the ticker code is food. These are all run by an ETF provider by the name of BetaShares. And so with another pro of using ETFs is the fact that you can, like we have done, create low-cost multi-asset portfolios. So for example, we've got our InvestSMART Core Growth portfolio that's run across a number of ETFs, and it's investing in multiple asset classes. And so we've put together our International Equities portfolio, which has international equities, so the one asset class, but multiple sectors, using multiple ETFs to get that. Now the cons, someone did ask me once, when would an ETF outperform its benchmark? Never. The ETF will always underperform the benchmark by the cost of its fees, and that's why fees are really important. As well, there's be tracking error. So, for example, I mean, the benchmark is not physical. It's just on paper, and so when you're actually investing in an ETF, they have to go out and physically buy the stock to get you those returns. So, of course, with transactions come costs, and with transactions, everything's not as smoothly as just writing it down on a piece of paper. So you will get slight variances there with tracking error. And of course, you get the good, the bad, and the ugly. Because you're not taking the time or the energy to and don't have the skill set to pick individual stocks, you have to accept the fact that just because a company's big doesn't mean it's good and it'll be in an index. For example, in Australia, in the ASX 200, I'm sure there's a lot of companies that you can think of there that you don't want to invest in. But if you buy an Australian ASX 200 ETF, you will be buying those companies as well as the ones that you do like, etc. So you have to accept the fact that you're getting the good, the bad, and the ugly. So, what to consider when buying? Focus on fees and size. The larger the ETF, the better for liquidity reasons. Now be wary of tracking error as well. That'll tell you just how well the team are at actually controlling that ETF as well. And be mindful of smart beta. I'm wary of it. We don't really use it too much here at all at InvestSMART. And when it comes down to actually creating a set of rules and then tracking those rules, of course they're creating them off historical data, and they're always buying the shares off historical data as well. But if you are looking to pick out a selection of stocks, remember that investing as well is, I like to think of it as a bit more of an art form than a science. And that's why our analyst team are good at it, because it takes a lot of independent thought to go into picking a basket of stocks that are going to outperform an index. So that's why we're just a bit mindful of smart beta. And of course, the more elaborate the set of rules and functions of that exchange traded fund, generally speaking, the higher the cost to the end user is going to be. So what I want to get into now is actually building your own diversified portfolio. It's pretty straightforward, and if you're watching, you will be able to do this afternoon. The market doesn't close till 4 p.m, so you can go out there and actually buy your own diversified basket of exchange traded funds to give you that instant diversified exposure to the global market, okay, and diversify yourself away from just poor old plain old Australia. So what we're going to do is start off by picking an appropriate benchmark. And so think of what benchmark you want to pick, and then actually start finding specific ETFs that match that benchmark. What we use specifically here is the MSCI All World ex Australia. So we know we're going to pick up a fair bit of America, Europe, Asia, and then the rest of those 23 developed markets around the world. So once you've picked those, you then need to get the ETFs that match up with those specific sectors. And what we do there, it's no surprise, we go back to what we were looking at before. We choose the biggest and the lowest cost producers. The biggest and the lowest cost ETFs that give us that direct exposure to those regions. So let's take a look at the regions that the MSCI All World ex Australia Index have on this next slide here. This is based on market cap. The US is the dominant figure here, so it makes up 60% of the world, of the developed world markets. Now, keep in mind though, when you're looking at the US, you have companies that are operating globally. Yes, they might be domiciled in the US or listed on the US exchange, but they are operating globally and getting revenues from around the globe. Like think of, say, MasterCard, Visa, Microsoft, etc. They're not just US-centric in where their revenue streams come from. So we've got the US, we've got Japan, we've got the UK, France, Germany, and the 16%, that is the green other slab. The other is the other developed markets of those 23 nations in the world that make up that box. So if, say, you're going to be using this, which is what we do, what you're going to be looking for is an ETF that gives you exposure to the US, and you want to, of your set amount that you want to invest internationally, you want 60% of that, if you're going to be tracking this, to go into that US ETF, or maybe multiple US ETFs, for example. And then 9% to go into Japan or Asia, etc. So let's jump ahead now, and let's start actually putting these pieces together into a portfolio. So for our US exposure, on all of these next few slides is our InvestSMART International Equities portfolio. And by going off the rules that we've set down, the largest, the cheapest, etc., that gives us that exposure, let's try and see if you can put together which ones we specifically use. I might have given it away before. We do in this one. Here's getting exposure to the US. You've got the SPDR, S&P 500. Now it's got FUM there of 20 million. Basically, that's only taken into consideration in Australia. It's got a good couple of billion of funds under management in that particular ETF. IVV, which is the iShares S&P 500 ETF, is the one that we use. 2.3 billion roughly in there last time I did these numbers, and of course at a management expense ratio of 0.04% per annum. You're really gonna have to try pretty hard to beat that. That's the cheapest fund I think I've ever seen anywhere. So that's the particular ETF that we use for international exposure in our portfolio. Jumping ahead to Asia, it's a little bit more difficult to get broad-based exposure to Asia. There's not too many Australian domiciled ETFs that will give you this exposure. Now, iShares pretty much has the market here currently, and they've got a number of them that focus on specific regions in Asia. What we've done specifically is actually go for the iShares Asia 50. So what we're getting there is exposure to the largest 50 companies in Asia. So you're thinking Alibaba, Tencent, Baidu, Samsung as well. I think Samsung's the third largest company in Asia. So they're the types of companies that we're getting exposure to there by buying into the iShares Asia 50. Now, as we talked about before, Asia has been on a terrific run. I believe the iShares Asia 50 ETF did approximately about 30% last year. So in the last 12-month period. So pretty damn good returns. So let's move on to Europe here. Now, once again, we don't actually use the largest here, but we use one that's got about half the management expense ratio of the other. So we use the Vanguard European index there at 0.35% per annum. That's for our European exposure. So that, of course, takes into consideration the UK, Germany, France, etc. And so that's what we're using for our exposure. Then the rest of the world. So to cover up that other section, we use the Vanguard All World ex-US. So that's at 0.11% per annum. So a really cheap rate to get that total global coverage when it comes down to handpicking these ETFs. I'm trying to think off the top of my head. iShares Asia S&P 500 had the highest management expense ratio at I think about 0.5%. And then this one here, 0.11, and of course the iShares S&P 500 at 0.04. So when you're constantly talking to people and they're hammering you saying you've got to go with low fees because fees always eat away at your returns, pretty difficult to get for a cheaper fee portfolio than this specific one that you can put together yourself to get that coverage of the MSCI All World ex-Australia index. So, and once you've put that together, if you're going to be tracking that index, you're actually going to be outperforming a good number of fund managers over the long run, because a lot of studies have been shown that a passive approach will beat these active managers because you've got lower fees, and the higher the fees are, the more they eat away at your returns. So if you can put this portfolio together yourself and buy just a handful of ETFs, you can beat the majority and be ahead of the curve and get your diversified exposure. So think about it when it comes to fees, about calculating your own MER. So what you need to consider is the cost of your brokerage, the underlying costs of the ETFs, your research expenses. When I say research expenses, say us, InvestSMART, we would be a research expense, because if you do subscribe to what we do, you are able to see all of our model portfolios and all of our model portfolios when we change them. So for example, right now, if you wanted a bit of a helping hand at what ETFs to buy to get international exposure, and it's more specifically at what weight, we will show you our exact portfolio every single day and the weight that those shares sit at. So you can actually have a subscription to our service, see our exact portfolios, and replicate that portfolio yourself at home and track it along. Now, of course, we'll manage that portfolio at our end here, and you'll be notified when we change it. And when we do make changes, what we'll be doing is looking for new alternative ETFs that come into the market that give us the same or similar exposure at a cheaper cost. So we look to actively lower that overall average management expense ratio. And then, of course, take into consideration the time that it takes you to do all of this. So when you're calculating your own personal MER, that's what I would think about. And for some people, it will make sense to use a low-cost producer like in the InvestSMART International Equities portfolio to invest in directly, because the overall cost to you as an investor will be less than this. But then for a lot of for some other people, say if you do have the time and you want to do it, in putting this portfolio together yourself, considering the cost of the subscription and the brokerage, your overall MER will be cheaper for you to do it yourself. Okay, so there'll come that tipping point once you work it out. So we don't want people just to invest directly with us. If you take out a membership, want to follow along and do it yourself, that's a big part of our goal here as well. So let's jump forward to the next slide here. Now, speaking of that portfolio, I've got the whole portfolio here. You can see the iShares the iShares Asia 50, the S&P 500, the Vanguard European Shares Index, the All World ex-US Shares Index. And then here's, I've thrown a curveball in here. Just to enhance the yield slightly, we use the BetaShares S&P 500 Yield Maximizer Fund. So what this particular ETF does for us, it provides us exposure to the S&P 500, but it actually produces enhanced yield. So what it does, it writes call options over the underlying stocks in the S&P 500 to generate above average income for the portfolio. But what that means is because it's doing that to generate additional income, the price is not going to be, say the S&P 500 goes on a run, it's not going to keep up with it. So it's going to underperform in a bull market, but give you more yield. It's going to outperform because of that yield in a sideways market, and it's going to outperform because of that yield in a downward market. So if you went and check that out after we're finished here, you'll see recently we've been in a bull market in the US, and that portfolio should have underperformed. But of course, it's generating around, last time I checked, and don't quote me on this, but about 4% per annum yield. Of course, that's unfranked because the US does not pay any franking credits. So, the last slide here, I do have our portfolio up just before I do go to some questions. So I'm gonna jump across from our from the formal presentation to the actual question section. If you haven't asked your question and you want to, please do it now. I'll get through to as many of them as I possibly can. But if I can't answer your question, of course, send me your email address or email me directly. My address is m.sneddon, SNEDDON, @investsmart.com.au. So I'm just going to quickly click out of this. Okay, we've got a few that have come through. Now, I think this first one is from Keith. It's regarding Japanese ETFs, and he wants to look to invest in regenerative medicine. I don't know of any very specific ETFs that invest in that very specific theme, Keith. Generally speaking, ETFs are much more diversified, but if you do want to invest in global healthcare, BetaShares have one. The ticker is DRUG, D-U-R-G. That'll give you exposure to overall healthcare. I did have a quick look actually before this presentation, and I saw there was one or two non-Australian based ETFs. So if you had an international broking account, you could gain access to these that do focus on Japanese healthcare as a specific ETF. But ones that focus on regenerative medicine, I can't even say it. I'm sorry, I can't point you in the right direction there. Let me have a look here. What are your thoughts on using the big ETFs with low management fees, such as? Well, Martin, I hope my presentation answered that question for you. We like them. We like them a lot. We like them so much, in fact, that our InvestSMART International Equities portfolio is made up of them. And because, so take it for example, because we're not experts at handpicking international stocks, we're using these to give us broad-based exposure. Now, if we were actually handpicking individual stocks, we're taking on much more risk because we're also taking on company-specific risk and sector risk with those companies as well. So because we're spreading that across, say, all 500 stocks in the iShares S&P 500, we're eradicating that risk and we're just giving ourselves broad-based exposure, which if you've seen the returns of the InvestSMART International Equities portfolio, I personally am invested in it. It's doing pretty well, and we're pretty happy with that. Jeff asks, on the InvestSMART website, the International Equities portfolio is rated as very high risk. My understanding is the portfolio is highly weighted in ETFs. It's all ETFs. If this is so, does it imply that these ETFs are also very high risk? So, Jeff, what we're looking at there is we're actually comparing international equities as an asset class against all other asset classes. So, for example, if international equities are very high risk, cash and bonds are low risk, so they're classified as low risk, then you go up the scale to medium risk, high risk, and then very high risk. So Australian equities on the asset class scale would be deemed as high risk. Then international equities, because we're stepping up and we're bringing in a few more risks there, for example, currency risk and the fluctuating currency, that's why we have to label it very high risk. So it's not because of what we're investing in, like the ETFs themselves are risky. It's the actual overall asset class compared to other asset classes. So when you're looking at bonds, for example, international equities are on the other side of the scale compared to bonds and fixed interest. I hope that answers the question there. We've got quite a few questions coming through. It seems to me that the exposure to international shares is understated, given that shares listed on the Australian market, e.g., what do we got? ResMed, BHP, CSL, etc. That is true, but not, of course, all of our portfolio manager. Sorry, Mark, our portfolio manager here. If you go in there and you click on next to, once you've put in, say, CSL, for example, and you want to flag that as an international equity, you actually can. And so what a lot of people who are using our portfolio manager have done is you click on the little cog next to the left of, say, of the stock code. In that cog, a drop-down list appears, and it's got asset class mapping. Once you click into the asset class mapping, you can type in the code, say CSL. It drops down the asset class section, and you can actually tick international equities. So when you go to do your portfolio health check or look at your overall asset allocation, it's going to see your CSL shares and it's going to relabel them as international equities. So a lot of people have done that, and still, as a whole, on the whole, people are still 80% underweight when it comes to international equities. So despite the fact of doing that and having CSL and BHP, etc., in their portfolios, they're still quite underweight to what they really should be having. And say in a high growth portfolio, that's 10 years plus outlook, we've got international equities sitting there at about 40%. Now, don't quote me on that because that's off the top of my head, but I believe that's the asset allocation that we have there. Let me see. Going through some companies here. What is the benchmark to say that we're 80% underweight to overseas stocks from Merv? This is according to the portfolio health check, Merv. So if you've entered in your holdings into the InvestSMART portfolio manager, and then you go and select from conservative to balanced to growth to high growth, as a whole, looking at all of those, compared to how each person who's said that they are, say, conservative, or said that they are high growth, or said they are balanced, As a whole, we're about 80% underweight compared to your ideal target. So that's the targets I'm referring to. So do go and check them out. Someone said, is buying an ETF the same as buying an individual stock in regard to how much you pay for it? E.g., can it be overvalued? Well, what the ETF, for a second there I thought you were talking about the brokerage that you pay on buying ETFs, but of course, yes, that's the same as buying an ordinary stock. You pay the same amount of brokerage. But can it be overvalued? Well, basically no. The ETF will always reflect the underlying value of the shares it holds. You might be referring to here, like say a listed investment company can trade, the share price can trade at a premium or a discount to its the underlying net asset value of the portfolio. But with an ETF, it will never trade above or below the net asset value of its underlying holdings. So you'll never be buying it overvalued or undervalued. You could be saying, is this sector overpriced if you're looking at a sector-specific ETF, or is this country overvalued? Have emerging markets become popular, so therefore people have piled in to those emerging markets? They're the questions you could ask yourself, but are you actually buying the underlying assets for more than what they're actually valued at on the market at the time? The answer is no. Let me have a look here. Merv asks, hedge or unhedged? All of our ETFs right now, Merv, are unhedged. We'll let the individual decide on that depending on your currency preferences or your risk tolerance. But right now, all of the InvestSMART ETFs are unhedged. We do have our investment committee, which is headed up by our chairman, Paul Clitheroe, and our head of research, James Carlisle, and our head of funds management, Alistair Davidson, and of course our CEO, Ron Hodge. And they do sit there and discuss this, but all of our ETFs are unhedged. Someone asks, we've covered exposure to geographical areas, but what about industry sectors? There are a lot of ETFs that specialize in industry sectors, and I think that possibly could be a good webcast for another time, because there's a lot to break down there. As I mentioned, there's cybersecurity, there's global agriculture, there's Japanese healthcare, there's of course currency, there's commodities. There's a whole stack, and there's only more coming out as well. If you watch these ETF providers, you're getting, I reckon, a new ETF by the day. That might be a bit of over-exaggeration, but there's a lot coming out. Let me see here. Let me see if there's any further. Someone else has asked about hedging strategies. As I said, Helen, we don't actually hedge our exposures here. There are a number of all of these ETFs basically can be hedged or unhedged. They have those options available by the individual ETF providers, and that really does come down to your own preference and where you see the Australian dollar right now. Can the Australian dollar strengthen from here? It could, very well could. Could it go down from here? It very well could. I'm certainly no expert on that. But right now we are unhedged with our exposure. So guys, it looks like we've come to the end of the questions, and it's starting to certainly get a little bit hot in here under all these lights. So I'm going to let you all go now and enjoy the rest of your afternoon. And we'll catch you at another time on another InvestSMART webcast. But if you do have any more questions, or you want to get in touch with me about anything I've spoken about today, reach me directly on m.sneddon, that's SNEDDON, at investsmart.com.au. You can also chat with me and the team. In the bottom right-hand corner of your screen, you'll see a little chat icon there. If you click on that, you can pop up and have a conversation. We're always available there. So thank you once again for joining me, and I do hope to see you next time. Thanks again.